Good afternoon, everybody. We're just going to give our group a little bit of time to gather, maybe a minute or two, so just sit tight. Oops. You hearing me okay? Okay.
Sure can.
Audio's good. Okay, that's about 2 minutes. We'll let the stragglers come in as we get started because we are on a little bit of a tight time frame. Got a lot of content to cover, so good afternoon. Thank you for taking the time to attend and learn about how do we refrain from emotional decision making as investors, specifically in the context of what drives decision making. And yes, we're focused on behavioral finance and investment, but also just more broader influence about decisions in social, what's called social thought. There's a huge body of work that behavioral finance derives its logic from, so we're going to touch on that. We're not going to get super technical. Jake's going to take us through some pragmatic examples, so it hits close to home. So I'd like to introduce you to Jake Roberts. He is the internal retirement investment consultant at Columbia Threadneedle, and he will be taking us through the paces shortly. My name's Jeff King. I'm a wealth advisor with 12 Points, and I've spent the last 20 years doing financial planning and advising clients. And with that, I will turn it over to Jake.
Thank you for the introduction, Jeff, and appreciate everyone taking the time. To reiterate, my name is Jake Roberts, and thank you for coming to learn about how our behaviors as humans affect our success as investors. In short, I'm going to show you how to protect yourself from the instinctual emotions that bubble up over things like money or retirement or whatever may be preventing us from living that happy life full of palm trees and umbrellas in our drinks. First, some background on me. I work at a company called Columbia Threadneedle Investments, which manages almost $637 billion in assets for investors around the world. We believe that the best client outcomes come from a consistent approach to investing, and this is born from a strong understanding of the relationship between our everyday, sometimes instinctual human behavior and how it might affect our investment goals. For years, we've studied what happens when markets are volatile and how people react. It's emotional. People change their strategy based on something that's happening right now instead of thinking about how it could affect their future. Today, I'm going to show you how our brain works when it comes to making these highly emotional decisions. But what do our emotions have to do with investments, and why does the makeup of our brain matter? Well, this is why. Negative 3.23%. This is how much the average investor underperformed in the market over a 10-year period. So for example, if an investor started with $100,000, that would translate to making $82,466 less dollars than the market returned over that same 10-year period. So $82,466 essentially becomes the value of working with a financial advisor that trains their clients to not give in to their emotional biases and instincts over the course of a 10-year investment window. So the question is $82,000 worth it for you to work with a financial advisor? I'd be very shocked to hear anyone here answer no. Our built-in biases, which are known as behavioral biases, can lead us to make mistakes and prevent us from making better investment decisions. The two types of behavioral biases are cognitive and emotional, and they stem from the part of the brain that controls our unconscious, reactive, and impulsive actions. Cognitive biases or errors create situations where a person processes data improperly based on their own set of beliefs or experiences, which may not be reasonable or accurate. These emotional biases create situations where a person ignores data completely and bases the decision entirely on emotions rather than logic. The biases we'll be exploring today fall into two buckets, the first of which is emotional. We'll be talking about overconfidence bias, which is overestimating one's skill as a factor in an outcome. And then we'll also be discussing loss aversion bias, which is when a person attaches more pain to a loss than joy to a gain of the equal size. The other bucket is cognitive biases. We'll be discussing anchoring, which involves making a decision that relies too heavily on the initial information received. The second bias we'll be exploring is pattern seeking, which involves interpreting information as a pattern, which leads to making predictions of what may happen next. The third is representativeness or gambler's fallacy, which involves basing decisions on only the portion of the data that relates to personal experiences. And then finally, we'll wrap up by talking about recency or availability. This involves assigning unfairly high weight to the most easily recallable information. Now, when emotions run high, the part of the human brain that controls these unconscious behaviors is the limbic system, and that trumps the part of our brain that controls our conscious thinking and reasoning. This often leads us to actions and decisions we may later regret. Now, I'm sure no one in the audience has done something they regret, but if you have, these limbic system reactions could just be the cause of that poor decision.
Can I volunteer an experience of my own here, Jake?
Yeah, go for it.
So 1998 to 2000, yes, I know I'm very young. It's hard to believe I was investing back then. I was in the software space. I rode the tech rocket like many of my brethren for a couple of years. I was in a software company that had run from $3 to peak at $98 within 18 months, from like 1992 to 1998 to 99. I round tripped it back down to about a little bit above the option price, about $6. And the whole time people are telling me, you're crazy. I have people in the business telling me you're crazy. I'm like, it's got to keep going up. Like, why? Well, because it keeps going up. It was a complete circular fallacy. And it was, it's embarrassing to even admit to it, but I'm doing it.
Thanks for sharing. And, I have a similar experience of my own. I began working for Fidelity Investments in the spring of 2020 after I graduated with a bachelor degree, and immediately assumed I knew best. I was in the business. I had just passed my Series 7, so I'm a broker. I can do this on my own, and inevitably lost a ton of money in the market while the market was bull. So just making poor decisions, thinking I could do it on my own, maybe had too much information at the touch of a button, and into some bad decision making. Now, there's psychological evidence that when the brain senses danger, it actually drains blood and sends it to our muscles so that we can react to address the danger. Think about how your body reacts when it's startled in the night or when you're physically threatened. Now, besides having a very spoiled dog at home, I am not a father myself. However, an effective analogy shared by some of my other colleagues is that of your child entering a dangerous situation. If you were to watch your child jump into a pool and it seems that he or she was struggling, it would be your instinctual impulse to jump in after them. It might be logical to remove your phone from your pocket before diving in, but in that moment, your brain enters code red. When we feel threatened, protective, or even in danger, our emotions send our body into reaction mode and trumps logic. We want to be sure that code red is not working overtime, especially while we're making financial decisions. When you think about it, money, earning enough of it and the possibility of losing it is emotional. In our world, we need money to survive. Without it, where would we get our food to eat, our house to live in? How would we create opportunities that we want for our children? Research suggests that our gut feelings are a default decision-making process. heavily influenced by emotion and biases that override logic and lead to poor decisions, especially in the area of investing. It's in these times of high emotion that we might be better served with the area of our brain that controls logic and reasoning, not emotions and gut reactions. Today, we'll show you how some common behaviors can lead to poor decisions despite your very best intentions. Let's start by talking about overconfidence. Now, it's great to be confident, but overconfidence is a form of self-deception. Jeff, would you consider yourself an above average driver?
I'm the best driver in Massachusetts.
Yeah, that doesn't say too much. And, addressing the audience here, I imagine that a large portion of you would consider yourself above average drivers as well. In a study that was done by AAA, 73% of people characterize their driving skills as above average. Now, if the group was well calibrated in addressing their own driving skills, we'd find that a third would identify as below average, a third average, and the final third above average. Now, would it be possible for 73% of everyone in the nation to be above average drivers? No. And the tendency to overestimate our skills extends to many areas, especially when there's perceived pride and ego. Now, the more information you have, the more false confident you become. In a 1973 study, 8 experienced gamblers were given data from 40 past horse races and asked to rank the top 5 horses in each next race. Data was given in increments of 5, 10, 20, and 40 bits of information that had been selected in terms of importance. And the more data these gamblers received, the more their confidence rose. However, their accuracy actually fell. Think back to when your parents, or even when you had small children, parents learned from books or from family members, which meant only the best and most curated parenting advice was passed down. Today, if you need some child rearing advice, there are millions of resources at the click of a button, which means there could be a whole lot of bad stuff mixed in with the actual good stuff. When you think about the sheer amount of information we're exposed to every day, it's obvious why we think we know it all. It's estimated that there are 8.5 billion Google searches per day, which comes out to 99,000 searches every second. And with the power of the internet behind us, it's easy to think we're experts in just about anything. For example, just this weekend, I hung some shelves in my apartment using the help of a YouTube tutorial. But by no means should anyone here hire me as their next contractor. Jeff, what was your most recent Google search? And then how long would it have taken you to find that information 25 years ago?
Well, because this was largely just a pure informational search, I looked up Bitcoin. I was trying to figure out what the 2024 outlook looked like, and it's trading at around $51,000 today, and it's up so about 16%. So I got those facts, but the overall outlook was bullish. I learned about this phenomenon called halving, which restricts supply, and that should drive the prices up. So now I know a little bit about a huge topic, and I think I know something. So in the past, I guess I would have gone to the library. I don't know if everyone knows what a library is, but that's a place with physical books. This would have been much more time consuming than it took me the 5 minutes that I spent on Google today.
Yeah, exactly. Today's investors, we have more access to data points than ever before. Years ago, the most astute investors probably had access to the Wall Street Journal, and maybe that was it. More data, it increases our confidence, but not necessarily our accuracy. Selecting the right stocks is extremely difficult, and it's this type of task that people exhibit the greatest overconfidence. We can even look at the different behaviors between genders to demonstrate this. Only 34% of American women self-reported feeling comfortable making investment decisions, while 49% of their male counterparts felt comfortable making those decisions on their own. Further to this point, a study called Boys Will Be Boys found that in looking at brokerage accounts from over 35,000 households, men were trading 45% more often than women. This trading resulted in net returns that were almost 1% less than the women's returns. Overconfidence often leads to trading more, which could translate, in this case, to losing more money. Now, if overconfidence is simple and straightforward, the next bias, aversion to loss, is tricky because it has to do with how we all individually perceive and experience risk. So here's a classic example. Let's consider 2 gain choices and 2 loss choices. In the gain scenario, I offer you $500 or the chance to flip a coin. If the coin flip results in heads, you win $1,000. If the coin flip results in tails, you gain nothing. Researchers found that in this scenario, most people choose to lock in the $500 gain rather than choosing to flip the coin. Now let's consider that from a loss scenario perspective. Now, in this case, you have to pay me $500, or you're given the chance to opt for the coin flip. If the coin flip results in heads, you lose double, $1,000. But if the coin flip results in tails, you lose nothing. Surprisingly, in this scenario, most would choose to gamble a larger loss for the chance to pay nothing. And this tells us that people are risk adverse when facing positive outcomes, but they're risk seeking when facing negative outcomes. Why? Because investors feel the pain of loss 2 or 3 times more than they feel the euphoria of a gain of an equal size. Now let's apply that to the financial markets. Between February 19th and March 23rd of 2020, the market descended into bear market territory quicker than ever before in history. The S&P was down 33.9%. With fears of a global pandemic bringing about a shutdown of the world's economy, investors piled cash into money markets, which were basically earning them nothing. Fear of loss was the root cause of this historic sell-off. We'll return to an example for 2020 in just a couple of slides. But another example I'm sure everyone can relate to. No matter where you stand politically, you probably remember the emotional roller coaster leading up to the 2016 presidential election between Hillary Clinton and Donald Trump. There was a barrage of sensational media headlines and the likes of which we had never seen before. Many people felt uncertain about the future. And in October, the month prior to the election, over $24 billion was withdrawn from the equity markets. We don't know for sure, but we can assume that went into cash or fixed income investments that people typically see as safer, less prone to loss. Then the election happened in November, and financial markets returned 3.7%. That was the largest monthly return in what was already a strong year, 2016. So guess what happened? All the investors who were scared and pulled their money out in October quickly returned to the market in December. Now their fears of loss went away and they didn't want to lose out more. So in December, almost the same amount, nearly $24 billion, was poured back into the equity markets. Now, much like the election period in 2016, investors recently faced another wave of anxiety and volatility. This time centered around the coronavirus pandemic. When it became clear that global economies, including our own in the United States, would face prolonged shutdowns, investors pulled $260 billion out of play in the market and piled into money market funds. But the difference here is that investors have largely remained uninvested despite a prolonged rally following the correction. During the next almost 2 years, the market returned 114% before seeing a correction in January of 2022. This rally took place with nearly $3 trillion still on the sidelines and investors missing out on those gains.
So what's Columbia's outlook for 2024, the election year? I'm just curious.
Yeah, that's a great question and one I've been fielding a lot. Really, the relationship between equity markets and elections is quite complex and nuanced. I'm sure everyone's heard rumors that one party taking office would be more beneficial to the market versus the other, but there really is no real data to support that claim. There is a history of volatility in equity markets surrounding elections, but much like 2016, we typically see a reversion to the mean in years following. I do have some resources that Columbia Threadneedle published and then some other third-party resources that I can share, just showing volatility historically and then the 6 months following if anyone's interested afterwards.
That's great.
Okay. Now, something else that I think is very important, especially now, regarding how we all consume our news. We know people look to social media platforms for information, and information is traveling faster now than ever before. And according to many studies, everyone, no matter their age, gender, wealth, has adopted social media as an important part of their life. And it can be a great educational tool when it's used correctly. Unfortunately, with investments, it's usually not. Take, for example, someone who's been really nervous about the markets. Frightening recession headlines can cause knee-jerk reactions driven by emotions. To make matters worse, because of the way the algorithms on social media platforms work, if you were to click on an article titled, will the market keep crashing? Your newsfeed is going to quickly be populated with similar articles. Soon, all you'll see is clickbait news about the worst market crash, further fueling the flames. One of the most common challenges investors face in the social media era is herding, or the everyone is doing it mindset. If you see a title like 3 investment trends you're missing out on, of course you want to click on it. These words are specifically chosen to target your emotions, telling you you're missing out on something that you should be a part of, which is herding at its finest. When it comes to investing, following the herd could mean following an investment trend when it's already too late to reap any of the benefits. We've seen this time and time again with examples like the dot-com bubble, meme stocks, and Bitcoin. It's easy for us as investors to be influenced and overwhelmed, which allows biases to show through. Speaking of Bitcoin, one recurring example of a social media domino effect can be seen for the rise and fall of cryptocurrencies. Bitcoin, which has trended in popularity among retail investors, very similar to meme stocks. The returns look attractive in the short term, but over the course of a few months can quickly plummet. Bitcoin surged to an all-time high of over $67,000 per coin in late 2021, and then rapidly fell down to below $30,000 per coin in early 2022, eventually hit rock bottom below $15,000 in late 2022. Despite being one of the most established cryptocurrencies, Bitcoin continues to experience extreme rises and equally rapid falls. All right, now we're going to move on to our cognitive biases, beginning with anchoring. Anchoring is another behavior that influences how we make decisions, and the term anchor refers to our tendency to hold on to what we're comfortable with. We allow it to influence our decisions, even though it may not be related to the decision we're trying to make. The anchor becomes the starting point, and we tend to make adjustments around it. In one experiment, a group of Columbia University business graduate students was asked to write down the last 4 digits of their telephone number and then take a guess and write down the estimated amount of physicians working in Manhattan. The group was then subdivided into 2 groups. The first group having low telephone numbers below 3,000, and the second group high telephone numbers above 7,000. The average guess for the group with low telephone numbers was 16,531, while the average guess for the high telephone number was 29,143, which was higher by 75%. Now, if someone had a lower number in their head, they subconsciously made a lower estimate on the number of doctors, and a higher phone number, a higher estimate. The 2 tasks obviously had nothing to do with one another, but the act of linking them together influenced the outcome subconsciously. Now, out of curiosity, I did a search of my own last night, and in 2023, there were an estimate of 53,700 physicians in the entire state of New York. How many of those are in Manhattan? I'm not sure. To continue on with anchoring, anchoring can be embedded in our brains, and we're not consciously aware of them, but they can influence how we react in a given situation. So let's look at 2 identical houses. They're side by side, they're in the same neighborhood, and both are listed with the same agent at the same time for $1 million. Both sellers equally motivated to sell, and a buyer who's indifferent to buy places a bid on both for $900,000. The question is, how will seller A react to the bid versus seller B? What anchors could be at work here? Jeff, who do you think is more likely to accept the offer of $900,000?
Seller A.
Yeah, absolutely. I believe seller A as well. That's the common response. And that's because seller A can look at the $900,000 sticker and see that he tripled his money over 15 years. While seller B, if he were to accept the $900,000 price, would actually be losing out on $300,000 over 2 years. So it's easier for seller A to think he's getting a good deal out of this. Now, anchoring happens in investing all the time because we make decisions based on our familiar associations. Let's take emerging markets, for example. Emerging markets economies are not as developed as the United States, and they often have lower per capita income. Examples of emerging market countries are China, India, Peru, and Chile. People in the United States hesitate when it comes to investing in emerging markets because they're not as familiar with those markets as they are with our market here at home. or it doesn't seem like these underdeveloped markets could produce the type of returns that the US could. So the US has become a frame of reference for us. It's become our anchor. But in reality, the growth potential of emerging markets is staggering. Over 50% of the world's population lives in the shaded area. Emerging markets make up 40% of the global economy, which has doubled over the past 25 years. Today, emerging markets are the biggest economy in the world, bigger than the United States, bigger than Japan, and bigger than all of Europe. The size of their middle class is now bigger than the United States middle class, yet we as investors feel unfamiliar, so emerging markets generally make up a small portion of our portfolios. Which brings us to one of the most common forms of biases that people tend to have, pattern-seeking behavior. Simply put, the human brain seeks patterns even when they're not there. Let's take an example many of us might be familiar with, the casino game roulette. The common understanding is that you place your money on red or black, odd or even, and you have a 50-50 shot at winning. For years, the casinos have made money off the fact that there are two green numbers, 0 and 00, which tilt the odds in the favor of the casino. But the casino really started making money when they installed number boards featuring the results of the last 10 to 15 spins. If anyone here has braved the casino floor of Concord and Everett, Mass., I'm sure you're very familiar with the screens displaying the most recent spin results. Many casino goers, including myself, have strolled by, looked at the board, and felt that there were too many reds in a row, and now it must be black's turn. They placed a substantial amount of money on the spin, not realizing the odds of getting red were the same each spin, regardless of the previous outcomes. Conversely, some people might see it the other way, and they say that black has the hot hand and place a large sum of money on black, thinking the odds somehow favor it as well. This is just a prime indication of the folly of pattern-seeking behavior. Let's look at an example of pattern-seeking behavior that investors have experienced in the bond market. So one common area where investors have experienced pattern-seeking behavior is in their search to predict the moves of the bond market. Let's try to predict it together. From the 70s to the 80s, interest rates had climbed from almost 8% to over 15%. In 1981, interest rates peaked at 15.8%. After they peaked, they started to fall. In the next 10 years, they went from the peak down to about that 8% starting point again. Investors started to predict a pattern. Can you guess what they predicted would happen next?
Going back up.
Yeah, right. They thought they were going back up. They predicted up. Investors assumed rates would return to that peak of 1981, but the problem was they kept going down and down and down. For almost 40 years, the pattern did not play out as expected. So if you look at it by decades, the pattern that actually happened was up, down, 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 and down again. We experienced an unprecedented period of decreasing interest rates, and it's been relatively easy to make money in the bond market for the past 4 decades, because when interest rates go down, bond prices go up. Yet the problem is not everyone experienced this easy money because they were too busy trying to predict a pattern that wasn't there. Investors who kept predicting that rates would go up mismanaged their fixed income investments and underperformed the market. Now, the next bias we'll be exploring is representativeness. Consider the following information about Susan here. Susan is quiet, scholarly, and passionate about social issues. She graduated from Stanford with a focus in English literature and environmental studies. Which of the following 3 cases is most probable? A, Susan is a librarian. B, Susan is a librarian and a member of the environmental organization. And C, Susan works in the banking industry. Everyone lock it in mentally. Jeff, what do you think is most likely?
Oh, B, she's a librarian and member of the environmental organization all the way.
Based on the information I gave you about Susan, B was the most common response. In a research setting, 1/3 of people chose A, 2/3 of people chose B, and under 1% of people chose the actual correct answer, which was C. Susan works in the banking industry. Remember, the question was about probabilities. There's nearly 2 million people who work in banking and less than 200,000 librarians. In any given situation, someone's 10 times more likely to be in banking versus the librarian profession. And the odds that he or she are both librarian and a member of the environmental organization are statistically remote. Yet 2/3 of respondents picked B. This is due to the bias of representativeness and the information I shared with you before I asked the question. All right, and finally, we will move on to talk about recency bias, which is the tendency for people to focus on what happened most recently. Think about an employee performance review, which we've all probably experienced. Some of us maybe in the last couple of months. The tendency of the reviewer is to remember the employee's performance from the past several weeks or months, rather than their performance over the course of the year or the entire period being graded. The employee may have a huge triumph or win 4 months ago, but maybe a slip up just last month. It's not far-fetched to think to yourself, my company is deciding on bonuses next month, better be on time, because we all pretty much know that it's more likely for the reviewer to focus on our recent tardiness rather than the job well done over the entirety of the year. So what does this mean for investors? Let's think about the 2008 financial crisis. After what happened, the Fed and global central banks put heroic monetary policy measures in place to recharge the economy. They kept interest rates low, trying to encourage people to spend money. As a result, investors had great returns in the decade after the financial crisis. In fact, it's been one of the longest and strongest bull markets in history. The issue is that investors were too focused on their recent poor experiences in 2008 to benefit from it. In fact, all but 2 of the years in the decades following the financial crisis, investors were still taking money out of the market and missing out on what was great returns. This is one psychologist's representation of the investment cycle. It may reveal the single biggest reason that investors tend to capture only a fraction of the returns in the underlying asset class they're investing. Investors rarely ride out an entire market cycle. When they start to experience fear or panic, they get out. On average, investors commit to an equity product for just 4 years and a fixed income product for just over 3 years. Now, the problem is that they buy and sell at the wrong times. They buy when they're at their peak of the investment cycle. They think the markets are good. They're feeling great about the returns they've already experienced, and they decide to invest more. But this is usually one of the most expensive times to invest. The opposite is also true. They sell when it's nearing the bottom of the cycle. Things may feel scary to them, or they're in a panic because something big has happened, but the problem is they're locking in low returns and won't be invested for when things start to pick up again. It's extremely important to be invested when things start to pick up. This chart shows the problem with not being invested during that time. The first third of a bull market is typically the most dramatic in terms of returns, but many investors don't capture the return during this phase because they're still on the sidelines. It's easy to see how missing the first stage of a bull market can greatly reduce your return over a full investment cycle. We touched on this in the beginning, but what it all comes down to is these behavior cause investors to make poorly timed decisions and underperform the market. We talked about that the negative 3.23% that the average investor underperformed the market. In the fixed income market, underperformance by 2.38%. It's quite dramatic and really leads us to how we counterbalance our emotions. We can overcome biases and mental shortcuts. How? Well, the role of a good financial advisor should not be underestimated. There are 5 key areas where advisors can help us overcome these problems. Number 1 is long-term focus. For most of us, long-term goals, aspirations, and objectives are big things, and the further away in the future they are, the easier it is for us to stray away from what we wanted. In some ways, we treat our future selves the same way we would treat a stranger. Advisors help us stay focused on what we want to accomplish. Number 2 is discipline through up and down markets. Rules prevent us from making rash decisions that we regret later. Knowing ahead of time what to do in case of certain situations will help us get through volatile markets and not make emotional decisions. Number 3, tax awareness. One of the biggest drags on investment returns is taxes. Advisors have the tools and the knowledge to manage portfolios more tax efficiently and help us as investors keep more of what we earn. Number 4, emotional objectivity. As we discussed, our emotions are very hard to manage. Making investment decisions is an emotional state can lead to very bad outcomes. Putting distance between investors and their money can help prevent some of the mistakes we discussed today. And then finally, education and guidance. The role of a financial advisor is to teach and guide investors towards achieving financial goals. In terms of overcoming emotions, guidance is by far the most important component. Education alone is not going to help us overcome those biases. When it comes to investing, time after time, we've seen that the smartest, most educated people can still make terrible mistakes. And finally, I will leave you with this quote by Benjamin Graham, the father of modern security analysis. The investor's chief problem, and even his worst enemy, is likely to be himself. So we've met the enemy and it's us. But the good news is that by understanding our own biases, we can prepare for future challenges. Again, thank you all for the time today. I'm going to go ahead and open it up to questions if anyone has any.
So Jake, first of all, thank you. That was a fascinating and pretty broad coverage of obviously a very deep topic. What, if you could kind of boil it down, how do you think the audience can apply what they've just learned?
Great question. I think the biggest takeaway that I hope everyone got today is the importance of speaking with and working with a financial advisor, and then having clear set goals. Make those long-term goals and prepare yourself for uncertainty that may be coming. If you really map out where you want to go, you can prepare yourself for the emotions you're going to experience on the road to get there, and a financial advisor can help you do that.
Okay. Let's give folks a bit of time to put some questions up. I don't see any yet. So come on, folks, give us one or two. There has to be some thought-provoking action that came out of it today.
I guess I just did a great job of explaining everything, Jeff.
Well, you boiled the ocean, and
yeah.
You did well. Okay, well, with that, thank you again, Jake, for an excellent job. Thank you, everybody, for participating. And this wraps up our presentation for today.
Perfect. Thank you for having me.
Okay. Our pleasure.